Here's a number that'll shock you: 1%. Just 1% difference in fees can cost you over $600,000 during your investing lifetime. But here's what nobody tells you: that's not even the biggest cost you'll pay. The real question isn't just how much, it's what are you actually paying for? Active investing versus passive investing. Two completely different approaches, two wildly different price tags, and here's the kicker: the expensive one loses 90% of the time. I'm about to show you exactly what you're paying for with each strategy, who's winning this battle in 2025, and most importantly, which one should get your money. Stick around because what I'm about to reveal will change how you invest forever. Let's talk real numbers. Right now, if you invest in an actively managed mutual fund, you're paying somewhere between 0.5% to 1% annually in fees. Some hedge funds, they charge 2% plus 20% of your profits. Passive index funds, 0.03% to 0.1%. Your brain is probably thinking, that's nothing, just a few decimal points. But watch this math. Let's say you invest $10,000 and add $500 every month for 30 years. The market averages about 10% returns. With a passive fund at 0.1% fees, you'd end up with roughly $1.13 million. With an active fund at 1% fees, $990,000. You just lost $140,000 to fees. That's a new car, a down payment on a house, or years of financial freedom. Gone. But here's the part that'll really get you. Active funds don't just charge more. 89.5% of them perform worse than the market over 10 years. After taxes, that number jumps to 97%. So you're paying more to get less. But before you think passive is the obvious choice, let me show you what that 10% who actually win are doing differently. Active investing is like being a hunter in the stock market. You're not trying to catch every fish, you're aiming for the biggest ones. You're constantly researching companies, analyzing financial statements, timing your buys and sells, trying to beat the market average. Think Warren Buffett picking individual companies. Think Cathie Wood betting big on Tesla before everyone else. These are active investors. Here's what you're actually paying for with those higher fees. Professional research teams analyzing thousands of companies, fund managers making daily decisions, trading costs from buying and selling positions, the expertise to potentially spot the next Amazon before it explodes. And it's not just mutual funds. If you're day trading on Robinhood, picking individual stocks, trying to time the market, you're active investing too, even without the fancy fund manager. The promise? Beat the market and potentially double or triple your returns. The reality? It's incredibly difficult. Even the pros struggle. But here's what's fascinating. In 2023, nearly 9 out of 10 Gen Z investors were actively making portfolio moves. Young people are trading more than any generation before them. Why? Because apps made it free and fun. You can trade with zero commissions in seconds from your phone. The cost isn't in fees anymore. It's in opportunity cost. Every bad trade, every emotional decision, every stock pick that flops is costing you money you could have made by just holding the market. And that cost is often invisible until years later. Now, passive investing is the complete opposite. You're not hunting for the biggest fish. You're buying the entire ocean. Passive investing means buying index funds or ETFs that own hundreds or thousands of companies automatically. An S&P 500 index fund, it owns all 500 of America's biggest companies. You're not trying to beat the market, you're becoming the market. Here's the breakthrough. In 1975, a guy named John Bogle created the first index fund at Vanguard. Wall Street literally laughed at him. They called it Bogle's Folly. Why would anyone want average returns when they could hire a smart manager to beat the market? 50 years later, passive funds now manage more money than active funds. By 2023, passive funds controlled $15.1 trillion versus active's $14.3 trillion. This is historic. For the first time ever, More money trusts the boring, simple approach than the exciting stock picking approach. And the reason is brutally simple: it works better. Back to those fees. When you pay 0.03% instead of 1%, that money stays in your account and compounds. Over decades, that difference is absolutely massive. But it's not just about cost. Passive investing removes human error. You can't panic sell at the bottom because you're not making decisions. You can't chase the hot stock that crashes next week. You can't let fear or greed control you. The passive investor in 2008 who held through the crash, they recovered everything and more. The active investor who sold at the bottom, they locked in permanent losses. In 2023 alone, investors poured $466 billion into passive funds while pulling $576 billion out of active funds. The market is voting with its wallet, but that doesn't mean active investing is dead. Let's be fair to active investing. There are real advantages that justify those higher fees for certain people. The biggest upside? The chance to actually beat the market. Let's be fair to active investing. There are real advantages that justify those higher fees for certain people. The biggest upside? The chance to actually beat the market. If you pick a stock that doubles while the S&P is up 10%, you've crushed it. That's the dream, and it happens. Some people have turned $10,000 into $100,000 by catching the right stock at the right time. Second advantage, flexibility. An active fund manager can move to cash if they see a crash coming. They can avoid overvalued sectors. They can concentrate money in their best ideas instead of being forced to own every company in an index. During the 2022 tech crash, some active managers who'd reduced their tech exposure early cushioned the blow for investors. Passive funds, they just wrote it down. Third, customization. Want to avoid tobacco stocks for ethical reasons? Active investing lets you do that. Want to focus only on dividend-paying companies for income? You can build that portfolio. Passive funds give you everything: the good, the bad, and the ugly. Fourth, it's actually engaging. Some people genuinely enjoy the intellectual challenge of analyzing companies and making investment decisions. For them, active investing isn't work. It's a hobby they're passionate about. But here come the disadvantages, and they're brutal. First and most obvious, the cost. We've already covered this, but it's worth repeating. Those 1% to 2% annual fees compound against you for decades. Second, the underperformance risk. Remember that 89.5% failure rate? That means if you pick an active fund randomly, you have a 9 in 10 chance of doing worse than just buying the index. And here's what's worse. The funds that outperform one year often underperform the next. Consistency is incredibly rare. Third, time and stress. Active investing demands constant attention. You're monitoring news, reading earnings reports, watching for sell signals. Miss a key development and your stock could tank before you react. It's exhausting, and emotional decision-making often leads to buying high and selling low. Fourth, concentration risk. Active portfolios typically hold fewer stocks, which means less diversification. If one of your picks goes bankrupt, it hurts a lot. Passive investors barely notice when one company in their 500 stock index fails. So, who should actually pay for active? You're a good candidate if you genuinely love this stuff, have serious time to commit, can emotionally handle being wrong often, and have money you can afford to lose without devastating your financial future. Here's a smart compromise. Use passive investing for your core retirement money, maybe 80 to 90% of your portfolio. Then, take 10 to 20% and actively invest with it. Think of that portion as your learning tuition. If you beat the market with that slice, amazing. If you lose some money, at least 90% of your wealth is still safely compounding in index funds. Now, let's look at why passive investing has won over half the market. Advantage number 1, brutally low costs. We're talking 0.03 to 0.1% annually. Some index funds charge less than what you'd spend on a coffee per year for every $10,000 invested. And every dollar you don't pay in fees is a dollar that compounds in your account for decades. Advantage 2. Instant diversification. Buy one S&P 500 index fund and you own 500 companies across every major sector. If one company goes bankrupt tomorrow, you barely feel it. Your portfolio is spread across technology, healthcare, finance, energy, everything. This dramatically reduces your risk compared to holding a handful of individual stocks. Advantage 3. It actually outperforms most pros. This sounds crazy, but it's true. From 2012 to 2022, simply holding an S&P 500 index fund beat about 90% of professional stock pickers. The tortoise really does win the race. Slow, steady, and predictable compounds into serious wealth. Advantage 4. You can't mess it up. There's no decision fatigue, no panic selling at market bottoms, no chasing hot stocks that crash the next week. You buy the same index fund every month whether the market is up or down. This removes human emotion, which is actually the biggest destroyer of investment returns. Advantage 5. It's tax efficient. Because index funds trade very rarely, only when the index composition changes, you trigger very few taxable events. Active funds that constantly buy and sell create tax bills every year. Over decades, that tax difference compounds significantly. And finally, time freedom. You don't need to watch CNBC, read earnings reports, or check your portfolio daily. Set up automatic investments, maybe rebalance once a year, and that's it. Your money grows in the background while you focus on your career, family, and life. But passive investing isn't perfect either. Here are the disadvantages. Disadvantage 1. You'll never beat the market. By design, you get the market return minus a tiny fee. If the S&P 500 is down 20%, so is your S&P fund. You won't be the person bragging about doubling your money in a year on a hot stock pick. The ceiling is lower, but so is the floor. Disadvantage 2. Zero flexibility. An S&P 500 index fund must hold all 500 stocks, even the overvalued ones. Even if you think tech is about to crash, the fund can't reduce exposure. If the market goes down, you're going down with it. No defensive moves possible. Disadvantage 3. You own the whole market's problems. If there's a bubble in certain sectors, you're riding that bubble up and then back down. In the late 1990s, tech bubble, passive investors held overvalued tech stocks all the way up, then all the way down. Active managers could have avoided some of that pain. Disadvantage 4. It can be boring. This is psychological, not financial, but it matters. Some people find passive investing mind-numbingly dull. There's no excitement, no adrenaline rush, no opportunity to prove you're smarter than the market. If you genuinely enjoy investing as a hobby, passive might feel unsatisfying. So, who should pay for passive? You're ideal for passive if you're investing for long-term goals like retirement 20 to 40 years away. If you have a busy life and don't want investing to be a second job. If you're a beginner without deep financial knowledge, and if you value certainty over excitement, you're okay earning the market's 10% average annually, knowing that's better than most professionals achieve. For the overwhelming majority of people, passive investing is simply the better deal. Here's the brutal truth. The biggest enemy of investment returns isn't the market, it's investor behavior. People buy high when excited, sell low when panicked. Passive investing removes those decisions entirely. Here's my bottom line. Active investing gives you the chance to beat the market, flexibility to make strategic moves, and customization for your values. But you're paying for that through higher fees, underperformance risk, time demands, and stress. It's only worth it if you have genuine passion, skill, and money you can afford to risk. Passive investing gives you rock-bottom costs, instant diversification, better results than most pros, and peace of mind. But you sacrifice any chance to beat the market, have zero flexibility in downturns, and ride every bubble up and down. It's the smart choice for most people, especially long-term investors. For 90% of people watching this, the answer is pay as little as possible. Buy a broad index fund for 0.03 to 0.1%, contribute every month regardless of headlines, and let decades of compounding do the heavy lifting. You'll outperform most professionals, pay almost nothing, save countless hours of stress, and sleep well at night. Want to be active with 10 to 20% of your money? That's fine. Treat it as education, not your retirement plan. But remember, over the long run, the boring, simple, cheap approach wins. The tortoise beats the hare. Every dollar you don't pay in fees is a dollar that compounds in your account. Over 30 or 40 years, those dollars turn into hundreds of thousands. Don't pay for performance you're not getting. If this video helped you understand the real advantages and costs of each investing approach, hit that subscribe button. I'm breaking down everything they don't teach you about money, week after week. Drop a comment and let me know. Are you team active, team passive, or doing a hybrid approach? What's your biggest investing challenge? Remember, investing isn't about being the smartest person in the room. It's about making smart decisions consistently over time. Keep it simple, keep costs low, stay invested. That's how you actually build wealth. Thanks for watching, and I'll see you in the next one.